Hello, welcome to Chapter 6b. In this chapter, we're going to do two things to improve our analysis of the financial performance of entities. First, we're going to develop a risk-reward framework to think about these entities within. And then second, we're going to build on the ratio analysis that we developed in the last chapter by adding market data and developing ratios with market data. So for those of you who are particularly interested in stocks and looking at the equity side of entities, this is the chapter for you. And with that note, let's just jump right in. All right, let's get started. So like I said in the intro, we're going to try and improve our methodology for analyzing the financial performance of entities in two ways. The first thing that we're going to do is develop this risk-reward framework, and that's going to help all investors, equity investors, bond investors, CFOs, stuff like that. And then second, we're going to add market data to our financial statement information and develop ratios, including that market data. And that's going to be especially helpful to equity investors. So for those of you out there who have been waiting to do more equity investing stuff, this is your chapter. All right, so let's develop our risk-reward frameworks. Okay, so all investors always should consider reward and risk. And I'm using the term investor very loosely. That, of course, includes a CFO who's got to decide, for example, with the CEO, if a new product should go forward or not. That's an internal investment decision. And also for someone who's thinking about buying stocks, buying bonds. Also for the CEO thinking about a merger, that would be an investment in another company, et cetera, et cetera. You get the idea. Okay, so let's start with debt investors. Okay, so for debt investors, reward is all about answering the question, what's our yield going to be, assuming the company doesn't flame out, assuming it meets all of the specifications of the contract that we're going to buy, that bond contract. And that's pretty easy to figure out with bonds because, of course, it's in the contract and you can compute the yield. We'll learn how to do that irrespective of where the bond is trading in the marketplace. And in terms of risk, bond investors want to think about what could go wrong with our reward picture. Okay, so for bond investors, what does that mean? It means something like, is the company going to default on this contract? Because pretty much you're guaranteed to get what's in the contract unless the company defaults and probably runs into Chapter 11, bankruptcy protection, and all that stuff. And another important question for risk analysis is, what's the probability that we're wrong? So what could go wrong? How likely is it that things are going to go wrong? And then finally, very important, how big a loss could we incur if we are wrong? So that's essentially conceptually the risk reward framework for debt investors. Now let's do the same thing with our equity investors. So for equity investors in terms of reward, there's one of two things that they're interested in, and maybe both depending on the investor. The first one is if we're buying an entity's equity as measured by stock certificates, how much more are we going to be able to sell these stock certificates for in the future than the price we're paying for them now, right? How much of a capital gain can we get out of this company's stock? Another important question is how big and reliable will dividends of this entity be? And you do that sort of assuming the stock price is going to be something like constant. Now, of course, many fast-growing entities, many tech entities, many medical device makers and early stage medical companies don't issue dividends. So in that case, all you're looking for is appreciation. And on the other hand, with some companies and some investors, especially those that are getting close to retirement, they may be more interested in getting dividends and getting a big capital gain. But nobody wants a big capital loss, right? Either of these two investors. And on that note, let's move on to risk for equity investors. So just like with debt investors, question number one is what could go wrong with our reward estimate? So for stock folks, that means will the stock price fail to appreciate? If we're looking for capital gains, if we're looking for dividends, will dividends be reduced or stopped altogether? In the Great Recession, and again in March of 2020, an enormous number of companies had great stock price depreciation, and also they cut very harshly their dividends or suspended them altogether. And also, just as in the case with debt investors, next question up is what's the probability, what's the likelihood that we are going to be wrong, right? Hope springs eternal, but what we want may not happen. And then finally, same question as for debt investors, how big a loss could we incur if we're wrong? And obviously, these last two especially are going to be estimates, right? Hopefully, with a little bit of careful thought, we can try and figure out what could go wrong. Not everything. There's always black swans that nobody thinks about, but we can think about a bunch of stuff. Okay, so let's see what happened here. All right. Okay, so second thing that we're up for in this chapter is we want to improve our ratio analysis methodology of last chapter by adding market data. This is going to be equity market data. Okay, so let's set things up for doing this before we jump right in. I want to make sure we're all on the same page with equity investing. Okay, because again, this is really, we're going to add equity market data. So this is really going to be helpful for equity investors. So let's think about equity investing a little bit before we jump in. Okay, so number one, first of all, who are these beautiful equity investors and how do we go about classifying them? Well, there are three big buckets of equity investors, three big types of equity investors. The first type are value investors. We've looked at them a little bit already when we looked at the balance sheet valuation method. We talked about some of the world's most preeminent value investors and what they're doing. And in particular, now in a little more detail, they're always asking, is the value of the company much, much more than its current market price? Or, of course, alternately, much, much less than its current market price? That would be, is our intrinsic value estimate much greater than what Mr. Market thinks the company is worth? And we're going to assume that we're only going to invest in companies where Mr. Market's price is going to converge to our intrinsic value estimate, and hopefully at some time in the near future, not the distant future. And what are our analysis methods for that? Always risk-reward framework. Everybody who invests, including equity investors, debt investors, CFOs, CEOs, et cetera, needs to have a risk-reward framework. And as we saw in Chapter 4 and Chapter 5, if you looked at it, the balance sheet valuation method is fundamental method for value investors. And the other thing that value investors use is what are called discounted cash flow valuations that we're going to learn about this term just a little bit later. And they typically look out to T equal forever from T equal now. They're trying to look at what's going to happen to the company for the rest of its life, and they're going to ask the question, what kind of cash flows are they going to throw off to me and other owners of the firm for the rest of its life? Okay, second type of equity investor are what we call value investors with a relative in front of that. So you can sort of guess ahead, we're going to have maybe another type of investor coming after this. Okay, so we've got our relative value investors are asking questions like, is the company we're looking at going to outperform its peers? Its peers are usually comps in the same industry. And then what they want to do is, of course, pick the best one in the industries that they're analyzing, or the market ones, the market sectors that they're analyzing. Okay, so we're assuming if we get it right, that we're going to pick the best company and that company's stock will appreciate more than its peers. What are the analysis methods that relative value investors use? Risk-reward framework, everybody uses that risk-reward framework, and they're going to use ratio analysis with market data, and that's in italics and red because that's what we're going to learn about in this chapter, okay? Okay. And they also do discounted cash flow projections, but they don't go out forever because they're interested in relative value. They just look at all the key companies in the industry for the next several years or so. So, because they're just trying to pick the winner for the next 6 months, 1 year, 2 years, 3 years, something like that. Okay. And finally, our last main type of equity investors are called growth investors. And these are the investors asking questions like, will the company grow its sales and will it grow its net income more quickly than sales? If you've got a company that's growing fast and it's growing its net income more quickly than its sales, you've got an awesome company. And Tesla recently sitting here in 2020 is a good example of that. I think personally the stock price of Tesla is way overvalued. But that says one of the reasons that it got there, aside from the Elon Musk mystique and all that jazz, is that for a while now it has been growing its sales very steadily, and it has been growing its net income more rapidly than it's been growing its sales. It was net income negative until a couple years ago. Okay, and they're going to assume that the price of these high growth companies is going to appreciate. So things like Tesla, Twitter, Facebook, stuff like that. Their analysis methods, they're going to use a risk reward framework just like everybody else. And they are also going to look at ratio analysis with market data, which is what we're about to start learning in a couple of pages. And they'll also look at discounted cash flow projections for several years. Again, not out for the whole life of the company, but just the next several years of the company's life. And so in this chapter, we're learning this ratio analysis with market data, and that's going to help us with relative value investors and growth investors. It's going to be particularly germane to those two communities of equity investors. Okay, so that was first of all to set things up for this expanded ratio analysis. Second of all, to set things up, let's review our three measures of equity. Measure of equity number one is GAAP equity, and that's defined to be assets measured at cost or cost minus where minus liabilities, right? And this is really a pretty crummy estimate of the pile of cash that would be remaining if we close the firm, paid off all the liabilities, right? And the reasons that it's crummy is that GAAP assets are measured at cost minus where. If we sell them all, they might be more than that. If we sell them all and close down the company, they might be worth less than that. And also, as we know, some assets are missing. And classic example of that is the Apple logo, let alone the Apple brand name. That is represented as zero, nothing on Apple's balance sheet. And clearly, anybody who bought Apple would get an awful lot from that brand. Even if companies go bankrupt, their brands can be worth a lot. Triumph Motorcycles, for example, went bankrupt, and the company was later, another company was started later with the same name, and they paid an awful lot to the leftover stub owners of the defaulted Triumph company for that Triumph name and trademark. Okay, enough of the motorcycle nonsense. So our second measure of equity is market value, right, which we call equity MV. Okay, so MV, as always, is equal to market value. Okay, and that's always, the market value is always just price per share times number of shares outstanding. So it's important that you know that. And that represents the marketplace's consensus view of the firm's worth to its owners at that instant in time. And Warren Buffett would say that that is Mr. Market's view of the worth of the firm. All right, so there's two of our measures of equity. Let's go on to number three. The third measure of equity we looked at in chapter 4 in the balance sheet valuation method. That's our intrinsic value, or we sometimes call true value of an entity's equity. And that's our best estimate of the firm's worth to its owners. And that is always going to be subjective, right? So let me underscore that. So you may come up with a different estimate of intrinsic value than me, and if we had everyone in the class do it, we'd have, what do we have, 450 or so estimates, and we'd probably want to take an expected value, look at the distribution, all that kind of stuff. Okay, and how would we all individually get our estimates of intrinsic value of a firm's worth? Well, some of us might use the balance sheet valuation method, others might use discounted cash flow methods, et cetera, et cetera. Okay, and now that we remember all of this stuff, now let's move on to ratios that use market data. Okay, financial ratios that use market data. The great news about this is that we can make most of these ratios by simply replacing equity gap with equity market value. So this is not going to be a huge deal to make this all work. So let's get started. Okay, so first up is return on equity market value ratio. Remember, we had return on equity previously. This is going to be the exact same thing. We're just going to replace gap equity with market value of equity, which is really much more useful. Okay, so let's get in here. Let me throw in a little bit of terminology that we'll be using throughout the semester, and any equity investor really needs to know. You'll hear thrown around a lot EPS or earnings per share. EPS is just short for earnings per share, and it's the net income in the period divided by the number of shares of stock outstanding, thus earnings per share. You can think of it as net income per share, same thing. All right, excuse me. So with that in our pocket, let's look at return on equity market value. So return on equity market value is going to be net income annualized. This is one of those ratios with an income statement number in the numerator and a balance sheet kind of number in the denominator. So we're going to want to be careful if we've got quarterly to multiply that income statement number by 4, right? Okay, all right, so it's net income annualized divided by equity market value, BOP. BOP, as always, stands for beginning of period. And also we could do this in EPS terms. Net income per share is EPS, right? So we could look at this as earnings per share divided by price per share at the beginning of the period. And as you can see here, through the awesome power of algebra, if we start with this on an EPS basis, the shares in the numerator cancel with the shares in the denominator, and then we're just left with net income divided by equity market value, beginning of period. Okay, so let's think about the meaning of this a little bit. So this is measuring how much income in the period was generated per dollar of equity market value. Okay, so this is a really, really helpful thing, right? This is saying, okay, so the equity market value, given what the firm was worth to its owners in the beginning of the period, how much net income did you produce for them in ratio form? Okay, and this is arguably the most important metric to equity investors. We said this in the previous chapter using gap equity. It's even more so now. It's better using market value of equity. Why not lenders? Same question that we asked in the same chapter. Because once we get to net income, interest has already been paid, right? So that takes the debt investors out of the equation. And now when we're looking at equity market value, that has nothing to do with lenders, with debt investors, right? Equity market value is just number of shares outstanding times price per share. And shares outstanding are certificates of ownership, nothing to do with debt. So there's really nothing to do with debt in this ratio. Okay, and what do we want with ROE? Same as we wanted in the last chapter. We want it positive, growing, and bigger than our competitors. And if we have all three of those things, we're really, really happy. Okay, all right, next up, price to earnings ratio. Okay, this is maybe the most common market value ratio. Even if you don't know what it is, I'm guessing that almost all of you have heard the phrase PE ratio previously. So let's check it out. Let's see what it is. Usually the PE is developed in price per share terms. So we have price per share in the numerator divided by net income per share, or EPS, earnings per share, in the denominator. And as usual here, through the magic of algebra, we can cancel out shares in the numerator and the denominator, and That's going to leave us with the market value of the equity today divided by annualized net income. So some of you, the inquiring minds among you, may have noticed that this sort of kind of pretty much looks like 1 over ROE measured on a market value basis, right? RE was net income annualized divided by equity market value. The difference, the reason that it's not, is that ROE takes the MV at BOP, okay, not at the PE takes it today. So that's why it's not exactly the same. It's because of the timing of when we're getting the market value of the equity. So why is this so popular? Well, think about, let's have our one sentence thinking about what it means. It's the amount owners pay today per dollar of earnings. That just intuitively, qualitatively makes a lot of sense. People like it and they like to see, is that going up or down based on the company's history? Where does it sit, that ratio compared to competitors, all that sort of thing. Okay, and one thing you should know is that there is more than one flavor of PE. So I'm going to go off on a quick tangent and give you a tip that is going to help you get an awesome internship and go on to be head of Blackstone or CFO of Google in 10 or 15 years. Okay, so you're in your job interview and you're nervous and they're asking you all sorts of questions, and then they throw out this question: what do you think about Tesla's PE ratio? Unfortunately, you have not been following Tesla. You have no idea about its PE ratio, and you don't really want to sound like you haven't been following Tesla and you don't know what to do. So instead of just throwing up your hands and walking out of the interview, what you should do at that point is say, well, I can't really answer that without knowing more. Are you talking about a forward PE for Tesla or a 12 trailing months PE for Tesla, or what? And then the interviewer is going to be taken aback and say, hey, this person is really a good critical thinker. We need to hire them. They're going to hire you. You're going to do an awesome job as an intern. And 10 to 15 years later, you're going to be the CFO of tomorrow's Google, and you started today. Okay, so anyway, let's think about this a little bit here. So the two most common PE ratios are 12 trailing months and forward. So 12 trailing months takes our equity market value today, it's always equity market value today, divided by the 12 trailing months net income, which as we know, for publicly companies is going to be the most recently reported 4 quarters of net income all added up, right? And that's called the historical PE ratio. All right, so this has the advantage that it's easy to compute, right? Because we have all the data. Okay, but what's the fatal flaw with this one? But it doesn't really tell us about the future, what this is going to look like with future net income, right? So that leads us to our next PE ratio, which is the forward PE. So again, we have here in the numerator the equity market value today, and now in the denominator we have net income for the 12 forward months. That's the forward PE. That's much more helpful, but this one has a fatal flaw. Okay, the fatal flaw with this one is, of course, we don't know what the entity's net income is going to be for the next 12 months, the next 4 quarters. And estimating that is something we're going to spend maybe 3 weeks on towards the end of the quarter. It's what equity analysts spend about 50% of their time doing for the companies that they cover. It's something that the CFO's office spends a lot of time doing so they can report these estimates to the board of directors, and it's not easy. So what I would recommend for us right now, since we're not so good at estimating this, and nobody is, if someone was extremely excellent at estimating this, they'd be a gazillion billionaire, right? So this is pretty hard to do consistently. But one thing that we could do is we could limit ourselves to big companies that have a lot of equity analysts analyzing away. So we might be able to get 20 estimates from those equity analysts of next year's or the 12 forward months net income. And we can just get that pretty easily on Google Finance or Yahoo Finance or Bloomberg or something like that. And that's sort of a wisdom of the crowds thing, right? We take the expected value and use that, and it's probably not so bad. Okay, so PE is so important. I want to spend a little more time on it. Okay, so if we find a company with a low PE, what does that mean? Well, to Warren Buffett, it probably means it's a bargain company. Okay, to someone who's a growth investor, on the other hand, it probably means it's a troubled company and they don't want to go anywhere near it. Okay, what if we find a company with a high PE? To Warren Buffett and most value investors, they're going to say that's an overpriced company. And for a growth investor, that's going to get them kind of excited because they're thinking probably the PE is high because everybody is expecting that sales and especially net income are going to grow very fast. So what the PE ratio means to you depends on what type of investor you are.